Hello everybody, welcome to a video tutorial, educational tutorial on charting strategies part 1. Over the next 60 minutes or so we're going to cover charting strategies. And typically when you hear the word charting strategies, I mean it's a very all-encompassing term. It could mean anything from the types of charts you use, the time frame and how you use the charts. You could talk about the patterns and pattern recognition that you see in the charts. You can talk about using charts to set stop losses and support and resistance. I mean, there's a number of different things. And finally, you can talk about indicators that you use as you lay on your charts. Now, in this part 1, what I'm going to do is just focus on some of the key specifics that I use when I set up my charts, and I use them to do my trading. And I do this whether I'm trading equities, bonds in the debt market, or currencies in the futures market, or commodities. And I thought what I would do is in this session just focus on some of the key things at a higher level. But I think over the next 60 minutes you'll get a pretty good understanding of a way to really improve how you use some of the indicators and how you set the charts up, or at least how I set them up. Now, before we start, though, let me just go through a simple disclosure. Trading in securities involves high risk and the loss of any potential funds invested, and any of the information that we provide in our user group may not be appropriate for all investors. And I provide this information without respect to individual investor financial sophistication, situation, time horizon, or risk tolerance. Therefore, any of the information and techniques that we provide in our user group in these education and tutorials, or on our website, or on our morning webinars or evening webinars, are provided for educational purposes only and are not intended to be a recommendation to buy or sell any underlying security, no matter what your rat brain may want you to do. So, having said that, why don't we jump in and just kind of take a look at first how I would define a skillful trader. And I view 3 mandatory things that a skillful trader must get right to be successful long term. I kind of view these as a foundational element for being successful in skillful trading. And these things form the pillars, as I said, of long-term success. The very first pillar is, in my mind, the most important, and that's risk management. You know, in our user group, there's several videos in this learning center here that you can find on risk management, and this is a very strong pillar of being a successful trader. Another pillar of success is what we're going to be discussing here today, and we're going to introduce in this video, is charts. You got to be able to understand charts very well to be a successful trader. And then the final pillar is strategy. Now, it's really interesting, and I'm sure you guys are no different than me that are watching this video. You probably get a lot of emails that come in promising untold riches. You know, 300% was made in the last quarter. Don't miss out on the next quarter. Make this money here, or how to never lose a trade, those kind of things. We've had 999 winning trades in a row. I mean, all of that stuff. And it's all focused on strategy. None of it talks about charts or risk management. They do that for a reason, folks. Most people love to talk about strategies. I mean, it's really, I guess, kind of sexy to talk about ratio spreads, back spreads, iron condors, broken wing butterflies, all those kind of really neat things. It's really cool to talk about those. I guess you'd be a hit at a cocktail party. But that's not really makes a long-term skillful trader. I can't tell you how many people focus on the strategy side, really mess out on the risk management side, and to some extent the charting side. And they're always fighting their trades, and they're always getting in at the wrong time. Their timing is off, and they lose money. Even though they have a fundamental understanding of the strategy that they deploy it the wrong way. Well, just to give you an idea of generally from everything that I've read and the research that's been done, risk management accounts for about 70% or so of your success as a long-term trader. So you better darn well understand risk management if you're going to be skillful at this long-term. If you want to build up wealth in your portfolio, you got to understand this. It's impossible if you don't understand risk management to build up long-term portfolio success. You might be lucky for 3 months, 6 months, even a year, perhaps a year and a half. But 5 years out, 10 years out, you'll fail if you don't understand the components of risk management. Charting makes up, I think, about 20%. Why is that? Well, I don't care what kind of strategy you're going to deploy. Even if it's a neutral strategy where you don't care, your direction indifferent on where the security trades, you got to start with a security first. And how do you select that security? Well, you're going to look at a bunch of securities. You're probably going to look at a couple of different charts. The chart is going to help you develop a bias, whether that bias is neutral or that bias is indifferent or that bias is bullish or bearish. You've got to be able to interpret the chart to be able to effectively develop a bias. Once you develop your bias, then you can then pick out your strategy. Notice here I've got strategies at 10%. Well, what I basically mean here, going left to right on these pillars, these foundational pillars, if you will, once you understand your risk management, which includes not only my stop loss for the trade or when I'm going to get out, but also how much I'm going to bet on the trade as a percentage of my overall portfolio. So risk management will keep you in the game long term, so that as you develop positive expectancy on your trades, you're going to make money over the long period of time. Charting, then, once you've got your risk management down, you look at the charts, you develop your bias, you understand how to develop a bias on the charts. Then after you've got your bias, then you develop your strategy. You go to your strategy shelf and say, okay, given what I'm seeing in the chart, I'm neutral to slightly bullish. Given what I see in the underlying security and the volatility and all the other little checklists that we cover in our group, now there's 3 strategies that make sense for that particular trade, and I'm going to choose strategy number 2. So now you've selected your strategy not first, but you've selected it after the underpinnings of your risk management have been defined for this particular trade, as well as how this trade fits into your overall portfolio, as well as the bias in the chart. So strategy comes last. But if you were to read a lot of these emails that you get in your inbox, you would think strategy comes first. But it does not, and this is where a lot of folks screw up. Now, how do I define a skillful trader? Well, to me, a skillful trader is someone who has an absolute value return of 15% above the S&P for at least 5 years. So first of all, I want you to focus on the time frame, 5 years. That shows that, you know, someone that gets in the market, like if you had bought, you could have taken a dart and thrown it up against the wall in the Wall Street Journal and picked the first 8 stocks that dart landed on March 6th, 2009. And then fast forward to today, and you have about an 85 to 90% probability that those 6 stocks would be up. Well, some of them up 2 or 3 times, most of them up at least 30 to 40%. Now, does that make you a skillful trader? No, you had luck and you had timing come into play. But if you can consistently beat the S&P for 5 years, that allows cycles in the market, up cycles and down cycles, and you're constantly beating the S&P. Now I define that as a skillful trader. So if the S&P finishes down 5% for the year, well, you take the absolute value, or 5%, add it onto the 15%, and now you're at 20%. Same token, if the S&P finishes up 10% for the year, you want to finish up 25%. So it's a good benchmark to set, and it's highly attainable. If you understand your risk management parameters, you understand how to interpret charts, and then you select the correct strategy for the bias you've developed on your chart given your risk management perspective. So that's how I define a skillful trader. Now, why don't we jump into that center foundation pillar, charting, and let's just look at some charting basics here for just a minute. Bar chart versus candle chart. I hear a lot of people talking about, oh, I use candles because it's so much better in interpretation. And I usually ask then, well, how have you been doing for the past 2 or 3 years? And I would say 6 or 7, 10 out of 10 traders, 6 or 7 out of 10 traders. I said, well, I haven't had a really good run over the past 3 years. Well, granted, we've had a huge downdraft in the markets and then an updraft. A lot of traders got caught, but I guarantee you, whether you were using a candle chart or a bar chart, if you didn't have the risk management and the charting bias set up, you probably lost money over the past 3 years. So did it really matter whether you're using a candle chart or a bar chart? No, it doesn't. In fact, a lot of professionals don't use candle charts. A lot of them just use bar charts because they know what they're looking for. Now, at the end of the day, it doesn't matter to me whether you use candle or bar. Doesn't really matter. I go back and forth between the two. However, it's not key to your success. There are other types of charts that are out there too. There's line charts, point and figure charts, Ichimoku charts, Kagi charts from the Japanese, and the Ichimoku. They're all different flavors of charts, and there's always those traders. They're primarily retail traders. They go for the latest flavor of the day. They're looking for the silver bullet. They go, oh, well, here's another way to look at the market. And then after they use that chart for 6 months, they realize they haven't made any more money or any less than they did using the other charts. So again, the type of chart you use, I generally stick with a bar chart and I'll bounce back and forth between that and the candle. But that's not going to make you successful. Picking time frames will. Determining your position size and hedging techniques with time frame analysis. We use multi-dimensional time periods to give you a little bit of an edge. Now, we're not going to cover that in this video. There's another really good video on multi-dimensional time techniques in our webinar tab in this learning center. But you need to match your trading style with your time period. So if you've got a day job, you know you're not going to be trading 10-minute bars, 15-minute, 30-minute bars. You're probably going to be trading day bars, unless it's the kind of job that you've got a lot of time to actively monitor the markets. And then once you pick your time period, you always go back up one higher time period to make sure you're on the right side of the trend. Again, multi-dimensional time periods and how you use them with charts is, we've got a couple of good videos on that, so I'd highly encourage you to check those out. Now, on this one, picking your indicators, we're going to focus on a couple of key indicators that I think really comprise about 70% of my bias as I read charts. Of course, you want volume and open interest if it's available. Some platforms surprisingly don't have open interest. But once you get into options and you also get into futures, you do want to see what open interest is. And volume is just strictly how many units for that security were traded that day. Open interest is how many are left open, because you can do that with options and futures. Moving averages, we talk about key moving averages in the settings that I use. And then the MACD, the actual name of the MACD is convergence divergence, and you'll see how I use that to a tremendous advantage. Relative strength, I'm a big believer in relative strength. Donchian channels and Elliott waves, we're not going to cover in this session. That'll be in part 2, but those are really key indicators that I also use. Fibonacci levels, average true range, ATR, Bollinger Bands, and ADX. These are primarily where I spend about 95% of my time. Now, folks, you can go to any trading platform and you can look and see that there's about 200 or 300 different trading indicators. And I'm not here to tell you one is better than the other, but I do know, at least from decades of using different indicators, that the ones that I use here they do work very well. They're very consistent. Try and stick with some that work for you and continue to learn and hone your skills. If you keep changing indicators, you're going to find that you're very inconsistent in your results. So in this session, the next few slides, let's go into some of these things and how I use them. We're going to spend some time on the moving averages, the relative strength indicator, and the moving average convergence divergence, or as most people call it, the MACD. Now, first, let's talk about moving averages, and then simple moving averages versus exponential moving averages. You're going to see here in this chart where I've got both of them in here, both of them compared. You can see the blue line here is a simple moving average. The exponential is red. Now, notice as this security starts to turn up right here, there's a gap and a split in the exponential and the simple moving average. The exponential moving average is more sensitive to movement of the underlying security. Why is that? Well, in this example here, you'll see that both of them, both the exponential moving average and the moving average, the simple moving average, use 10-period look back. And a period is 1 bar, whether it's a daily bar, a 60-minute bar, or a 1-minute bar. So it's a 10-period or a 10-bar look back. Now, you can see here that the exponential is more sensitive to the up movement. The simple moving average does move up, but it's a little bit slower in how it reacts. And then you've got this topping action, and then you've got a movement down here with the underlying security. And you can see the simple moving average, or the exponential moving average, actually starts its move down right here. The simple moving average continues up 1 more bar, and then it starts rolling down. So you're going to get a little bit more sensitivity in the exponential moving average. Why is that? Well, rather than just calculating across all 10 bars, or whatever look back period you use in your settings, rather than just calculate the exact same number, so there's an equal weighting from this bar to this bar in a simple moving average. In an exponential moving average, there's a greater weighting to the most recent bars. All right, so as these recent bars have like this big up move like you see right here, there's a bigger weighting to that than this small move here or the small up move here. So that's why you get this separation. I use exponential moving averages all the time. It's not as important as you get out in time. In fact, a lot of folks, you'll see that when you get out to 50 and 200 moving averages, some of them just stay with SMAs rather than EMAs. I leave everything in EMA. That's the term that most people use, or an SMA. I usually leave them all as EMAs. Not very... won't hurt you if you left longer term moving averages as SMAs, but I leave them all as EMAs. Now, if we look at the next screen here, we look at the moving averages and just focus on these just for a minute. Major moving averages you need to have an eye on every day. And the reason for that is because a lot of black boxes and a lot of big money is moved based on the underlying security and its location to its 50-day moving average and its 200-day moving average. Now, I use, as I said, EMAs, and I use a 4 EMA rather than a 5 EMA. These are some that I like to use, but you can use a 5. And I use a 12 EMA, and you can use a 20. So in the shorter term, I use a 4 and a 12 EMA. Why is that? Well, typically what happens is a typical trend is going to run, generally a trend is going to run for anywhere from 7 bars to about 20 bars. That's a typical trend. Now, remember what I said, a bar can be 1 day, or a bar can be longer than 1 day. A bar can be a week, or a bar can be 5 minutes. But a typical trend is going to run 7 to 20 bars. Remember, a stock doesn't go like this, or a stock doesn't go like this. A stock will run up kind of like this, and then have a little bit of a pullback, and then continue its run up. These pullbacks here are counter trend trades, but that 7 to 10 bar count is really in this area right here, okay? That would be typically a trend, and then it reverses for 5 to 10%, and then it resumes its trend back for another 7 to 20 bars. Well, generally, this 4 and 12 EMA captures that nicely. A lot of people are in and out of markets anywhere from 3 to 4 days to a month, maybe a month and a half or 2. And granted, you may have some longer term trades if you're using a weekly, but generally, just even if you're using a weekly, the trend runs 7 to 20 bars before you have a 5 to 10% pullback. And that's just based on studies that have been done here. So I like to use the 4 and the 12. And then, of course, the 50 and the 200. And as I said, you can make them SMAs or EMAs. I keep everything EMAs here. And the crosses that are very important, of course, are the 4 and the 12, or you could use the 5 and the 20. And then the 50 and the 200. These are very important crosses. Short-term trades generally are taken for the swing trader with 4 and 12 cross or the 5 and 20 cross. And then with the 50 and the 200, those are a little bit longer term trades where you're positioning your portfolio more dramatically, whether you're above or below the 200-day moving average. And these indicators, these moving averages, are very good across all time frames, whether you're using 1 minute bars, 1 day bars, or 1 week bars. They're very good across all time frames, and they work out very nicely. Now, let's jump into the RSI as the first indicator that we're going to put on our chart. The RSI is a very simple indicator, really, in its functioning. It was developed in the 70s. And the 70s, you're going to notice if you study technical analysis, a lot of the core fundamental indicators were developed in the 70s and early 80s. Why is that? That's when computers really kind of took hold in the whole trading community, and everybody got away from hand plotting price action on a paper chart every day when the newspaper came out in the morning. And that's how I did it when I was a little kid, believe it or not. I mean, you'd think I had a great summer, but that's what I did. And you can see here that Wilder came up with the RSI, and it's been very successful. One thing about the RSI, it's a momentum indicator. It measures momentum, and it measures it in 2 different ways. It measures it across speed, and it measures it across change. So you're looking at the speed of the price movement, and you're looking at the change of the price movement. And the way that this RSI is constructed is it's been constructed so that it oscillates as an oscillator between 0 and 100. And generally, you can set your bars as overbought and oversold, and I use them at the standard factory settings, overbought and oversold. 70 is considered an overbought area, and under 30 is considered a oversold area. So any time the price action in the RSI goes over 70, it's considered overbought, and then when price action goes under 30, it's considered oversold. And as you'll learn, stocks can stay overbought for a number of months. They can stay oversold for a number of months. So the effective use of the RSI is being able to accurately interpret it, but then you've got to marry it with another indicator or 2 that really give you the signals that you need to do to be able to develop your bias. Now, divergences do occur in the RSI, and I use them a lot. In fact, all the time. And they can be leveraged, and when they really have merit is when they're used and married with the MACD indicator, which I'll show you here in just 1 minute. So these are how these 2 can be constructed and used together. Now the RSI calculation, it's a standard 14 period look back, and it could be just as easily said as a standard 14 bar period. So again, whether you're using 1 minute bars or 1 day bars or 1 week bars, it's 14 bars that it goes back to do its calculation. And what is the calculation? Well, it's very simple. You take the average gain and you divide it by the average loss. And then it's converted into an oscillator by multiplying it, by adding it to 1, dividing it, and multiplying it by 100. That gives you the 0 lowest it can go to the highest it can go, 100. It keeps it defined within that 0 to 100 range. And that gives you the oscillation of the calculation. So now if we go take a look at this just to kind of see how this thing really plays itself out here. Excuse me. Let's go look at this simple RSI here on this chart. You can see right here, here's the 70 line. And here's the 30 line. You can see the standard setting with the RSI. Generally, you'll see it as RSI, and you'll see the period in here that it's set up at 14. Now, anytime you go over 70, it's considered overbought, as you can see by the red arrows pointing down, and anytime you're below 30, it's considered oversold. All right, and this gives you a general indication of a possible area of bullishness down in this area down here, or bearishness up in this area right here. And understand, as I've got here, RSI is based on closing prices. And you can see here this line here in pink, that represents the closing prices. You can see the bar and how wide they swing. But the RSI is going to be based on this price right here, not the fact that the price went all the way down here. It's based on where the price closes. So now you've got a definition of RSI from both overbought, oversold. The other area that I think I want you to pay attention to, which in my mind a lot of traders don't, but it's very important, is this area right here, that 50 line. The 50 line indicates where momentum has turned positive or momentum has turned negative. I use this as a positive negative momentum indicator within the RSI, and I use that to trigger some of my hedging techniques that I use with the portfolio. Notice also that you can have a bounce off this 50 line right here. You can see right here that price stayed pretty much above the 50. It would come down and touch this 50 line and bounce. It would touch and bounce several times. It bounced right here, and then finally it succumbed right here. So price finally weakened to the point where, okay, now I'm capitulating and I'm going down. Notice in this entire area right here, even though we had several overbought conditions, the stock was fairly in a nice little uptrend. Starting right in this area right here, the stock was kind of in an uptrend until we finally came right here, right at this point right here, and then the RSI finally moved below 50. And once the RSI moved below 50, let's say you wanted to hold this security right here, well then there's things that you need to do to take into account to be able to hedge this security so that when it continues to run down like this, you're not expecting it to go up here and wondering what happened, and you're holding it down here like this and you got a pretty substantial loss. So again, this is a nice way to use the RSI. But remember, the RSI by itself should not be considered as how you're going to trigger a trade. You need to apply it with another indicator. So if we look at the MACD, it's another momentum indicator like the RSI. And again, it was developed in the 70s as well. So the 70s turned out to be pretty good for a couple of really solid indicators. And you notice they're still out in the markets today after 40 years of continued use and development. These indicators are holding the test of time. They're not, just here I am and there I go kind of thing. These indicators have been very rock solid for a number of years for traders that really understand how to apply them. It's also, as I indicated earlier, called the moving average convergence divergence. And you can see right here where you've got that taking place here. And that can also happen in the RSI. So married together, both the MACD divergence areas and the RSI divergence areas really enhance its capabilities. Now, the other thing, like the RSI, the MACD can generate a number of different signals, and you've got to understand how to look at these different signals. There is first the signal line crossovers. Those are the ones that I think most traders are familiar with. But another one is center line crossovers. I think some traders use that, but many don't. They're not even aware of it. And then finally, divergence signals. You're taking all of these signals and you're laying them on top of divergence. And then you're taking those divergence signals with the MACD and you're laying them across what the RSI is already telling you. So combined, this gives you a higher trade or a higher probability trade and helping you develop your bias. And once you've got that down, then selecting a strategy is very basic. Learning different strategies is just an educational event, and there are a lot of smart people in the trading world. So learning the nuances of setting up a strategy is not difficult, but picking the right strategy, you got to be able to understand this first. So the MACD, as I said, is all about convergence and divergence of two moving averages. And let's go into the MACD calculation. Now, a lot of people, surprisingly, they use the MACD a lot, but they have absolutely no clue how the MACD is calculated. A lot of people think, well, I've got a 12, a 26, and a 9, which are the standard out-of-the-box settings, all right? So that means I'm using a 12 moving average and a 26 moving average. So those must be the two that are in my MACD down at the bottom. And then the 9 must be some other pattern that compares these things. Well, not really. When you see a pattern down in the MACD, you're not really seeing a 12 moving average, nor are you seeing a 26 moving average. What you're seeing, quite frankly, is the difference between a 12 and a 26 moving average. You're seeing the difference. And then that difference is plotted as a line. That line is called the MACD line. So both of these two right here, this one and this one, go into the calculation of creating the MACD line. Now, once you've got your MACD line, you create a moving average of your MACD line, and that moving average is based on that third number right there. So it's a very sophisticated yet simple calculation that goes into this, but most folks don't understand how it's done. So why don't we take a look at it here for a second. The MACD line. Well, in this particular out-of-the-box setting, it shows 12 days. And by the way, the MACD is always done using exponential moving averages, which, as we just learned, applies more weight to more recent bars than prior bars. So we take the 12-day EMA and we minus the 26 EMA. And that can be a positive or a negative number. And then that creates what's called the MACD line. All right. Then you take the signal line, which is the 9-day, in this case here, EMA of the MACD line. And then that gives you the signal line. The MACD histogram, which a lot of traders they look at, but they don't really understand it, really represents the difference between the MACD line and its 9-day EMA signal line. Now, I think let's go to the charts, and I'll show you how all this works out so that it makes a little bit more sense here. What you're looking at here is essentially, in a very creative way, you're looking at a MACD line that's plotted down here at the bottom. Remember, that is these two right here that go into creating a MACD line, the 12 and the 26. You're seeing here a 12 EMA and a 26 EMA. And you're seeing that you've got the 12 EMA going below the 26 EMA, which means you go below the zero line. When the 12 EMA goes above the 26 EMA, the MACD line goes above the center line. And you can see every time that you've had those crosses, you have the corresponding cross in the center line. So this is the MACD line. This is just one of the lines in the MACD. And it represents, as I said, the difference between the 12 and the 26 EMA. So if we look at the current price over here, you'll see that the short-term moving average, or the 12-day, is at 22.68. So right there, if we were to plot that on the graph, it's at 22.68. The 26 EMA is at 21.65, so it's slightly less, 21.65. So now when you subtract the two together, the 12 from the 26, because you always subtract the first number from the second number to arrive at a positive or a negative number. In this case, you arrive at a positive number of 103. So that means momentum is moving up and you've got a positive number. And that's what these numbers are over on the right-hand side. And by the way, these aren't bounded by 0 and 100 like the RSI. They can go up and down. So obviously the higher up you go means the further the 12 EMA is moving away from the 26 EMA. In this case, it's only 1.03, so you can see right here, you're right at 1.03. Okay? So that's how this works. That's how this part of the MACD is constructed. Now, if we were to go in and let's take a look at the other part of the MACD, which is the signal line, which is now laid on top. So we got a 12-day and a 26-day EMA. Now we took, that created this black line, which is the MACD line. So remember, this black line is the difference between these two lines right here. But now the signal line is 9, which is an out-of-the-box MACD setting. Remember, the MACD setting was 12 right here, 26, and then 12, or 9 rather. And that 9 is the moving average of this MACD line, which is the difference between these two moving averages. And you can see here, every time you got the cross here of the signal line and the MACD line, it gives you a signal that you may or may not take depending on what the rest of the chart settings are giving you. So that is how the MACD line is constructed. And then the histogram down here simply gives you the difference between the MACD line, which is the black line, and the signal line, which is the red line. So anytime you cross and the MACD line goes below the signal line, the MACD is below 0. Or the histogram is below 0. Anytime the MACD line crosses above the signal line, then the histogram is above 0. So you can see you've got a number of really wonderful, great things working for you in a MACD. Now, all of these are put together to give you a really nice pattern. Now, what I'd like to do is spend about 10 minutes or so. Let's look at a couple of charts, and let's look at some bullish and bearish divergences and how I trade these. The first thing we'll do is, before we go look at the chart, I want to go to the TUG whiteboard. And I want to define bullish and bearish divergence. All right, so if you've got let's consider this is the MACD line, and it's coming up like this, and then it comes down like this, and then it comes up, and then it goes down like that. Okay, so let's say that's the MACD line. Now let's put the signal line in there. And the signal line, if you'll recall, is the moving average of the MACD line. So the signal line comes up like this, and then it kind of goes like this, and then it comes down like this, goes up like this, and then comes back down like this. That's the signal line. Now let's put the let's put the price movement of the underlying security right up here. So the underlying security is moving up like this, right? You got the MACD, it's moving up, and then you've got it turning back down like this. It's coming down. And then you have the price of the security moving back up again. And then it's coming back down again. All right. So now, bearish divergence, as I define it, and this is bearish divergence, and we'll call this the 0 line on the MACD, okay? When you are north of the 0 line, you can only have bearish divergence the way it's defined by me, all right? Only bearish divergence. When you're south of the 0 line, you can have bullish divergence. So it'd be just the mirror image of this flipped over the other way. So now, looking at the north side here, we see that we've got, and remember this is a momentum trade. The MACD is a momentum indicator. So you got a cross right here. That's one cross. That's number one. And I'm watching this stock move down the line here. And then all of a sudden I've got another cross back to the upside. Okay? And the stock is moving back up. And not only is it moving back up, but it actually forms a higher high than this right here. You can see right here that if I were to connect these two lines right here, like this, it's actually a higher high. But notice down here when I got my third cross, right here, I've got the MACD moving in that direction. That's bearish divergence. Remember, this is a momentum indicator. So this move up here had a lot of strong momentum right here. And then we had a normal pullback. And then this momentum move here had a lot less momentum behind it. It's running out of juice, which means this move down here could be quite substantial. Now, sometimes the MACD line and the signal line will move below zero, or sometimes it'll bottom and then start to turn back up again. But you've got a really good impulse move to the downside right here. That's classic bearish divergence and a very solid trade. All right, that's a very solid trade. This is the ideal setting. You've got here one signal, two signals, and then three, which is where you take the trigger. So it takes three crosses here to take this trigger and to take this trade. So if we go to look at a couple of charts just to show you, and we'll focus on this for just 1 minute so that you can see how this thing plays out. Okay, what we're looking at here is the Dow futures. And what I thought I'd show you is a classic case of bearish divergence, which I had our members jump in on with a specific trade here. So if we look at this, you'll see right here, we had a high form right here. And the MACD line had one cross right here, didn't cross here or here, but then we had our second cross right here. And you can see right here where the MACD started coming back up, or the price action started coming back up, and actually had a little bit slightly higher high than this high right here. Then we had a cross right back here. So that's a classic case of bearish divergence. And it came down, it had a nice little impulse move right here. But notice we didn't go below the zero line, which is this red line right here. And we immediately had a cross and started moving back up. So that said, it was a very short trade right here. So that's just one example of bearish divergence. Let's take a look at another. All right, here's one that's a little bit more complex. Looking at IBM, you can see the stock made a high right up here and then it had a pretty good pullback. So we had a cross in the MACD. And then we had several crosses right here. But notice during these crosses, we never did take out that high right there. Now, right at this point here, we were right. We had bearish divergence. We took that high out. So someone who's a bearish divergence trader could have taken this trade for a nice little gain. But then notice right here, we had a cross back to the upside. And then we came up, and now here, we really took out that high from over here. So, and notice here, when we hit this cross right here, we're still down here. This is still a little bit of a bearish divergence. So this would have been another really good trade here to take. We came back up. We took these highs right here and we settled on these highs for a while, and we slowly started to roll back down. So this would have been right here, we're almost dead even. So slight bearish divergence. You could have looked at this trade as a possible trade to the downside as well. So bearish divergence is really, and remember what I said, they can run from 7 to 20 bars as a trade. And this went to about 9 or 10 bars right here. So bearish divergence trades really work out very nicely. And if we look at a couple of bullish divergence ones, you'll see the same thing happen here, only in reverse. Let's take a look at one. Now here we're looking at the Dow futures again. And in this particular example right here, you can see here where we made a low right here and we came down and we challenged this low right here. But notice we had a cross in the MACD, and even though we had a lot of chop in this area right here, we were back up in here. So we did not even match this low here. But when we finally came down and we took out this low right here, which was we taking this low out, now you've got a good valid bullish divergence. This is just the opposite, where you've got this thing moving up like this. So that would have been a signal. In fact, I got a lot of our members in a bullish trade here on the futures of the Dow, or the diamonds, whichever way you wanted to play it. So that turned out to be a pretty good trade. The other thing is, if I clear this out, I want to show you the other side of this that was also apparent. While you've got this bullish divergence going on in the MACD, you've also got dramatic bullish divergence going on in the RSI. So we hit and we actually took this low out right here. So this low right here was lower than that low right there, yet we're showing improving momentum here. So these kind of trades are high probability trades when you marry them up together. So There are a number of different nuances to bullish and bearish divergence, and we'll cover them in part 2 and part 3. But I wanted to just kind of put these out here to show you the different ways that these things can go here. All right, everybody. I hope you've enjoyed our session on charting part 1 with the RSI and the MACD, and stay tuned for others to come out. Bye now.